Hey everyone, welcome back to Corporate Decoder. Today SIG just filed their latest quarterly report, and I'm seeing some interesting trends in their sales numbers that really stand out. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's sales are up slightly, but dig a bit deeper, and you'll see some brands are really losing ground while others are booming. Alright, let's dive into Signet Jewelers Limited's latest financial report. It covers the first quarter of their fiscal year 2027, which ended on May 2, 2026. Looking at the top line, total sales for the quarter were about $1.55 billion. That is a small increase, just under 1%, from the same period last year. Merchandise sales, the bread and butter of their business, stayed pretty much the same, while service sales, like extended warranties and repairs, saw a decent jump. But here is where it gets interesting. While overall sales are up a tiny bit, the overall gross margin, which is pretty much the profit after accounting for the cost of the goods sold, actually went down. It dropped from nearly $600 million last year to about $556 million this year. That means they're making less profit on each item they sell. They explain this as merchandise margin decline due to increases in gold prices and other factors. It also seems they had to write down some inventory by almost $33 million because they are closing down the James Allen and Rocksbox websites. That is a big hit. On the bright side, their selling, general, and administrative expenses, the costs of running the business like marketing and salaries, went down. They spent about $510 million this quarter compared to over $526 million last year. This helped offset some of the lower gross margin. This led to operating income, which is the profit from their core operations, falling to about $37 million from over $48 million in the same period last year. And after all the costs, including taxes, net income also saw a dip, coming in at about $31.7 million for the quarter, down from $33.5 million last year. This means earnings per S-share remained the same at 78 cents on a diluted basis, even though the net income was lower. This is because they bought back some shares, which makes the earnings spread over fewer shares. Now, let's talk about the brands. In their North America segment, sales for Kay Jewelers actually grew, which is good. Zales also saw some growth. Jared, another big brand, had sales that were pretty much flat. However, Blue Nile's sales were down, and James Allen, which they are transitioning to become part of Blue Nile, saw quite a drop in sales. This brand was a drag on their overall numbers. Their international brands, mainly in the UK, showed a nice increase in sales, even if you adjust for currency changes. Looking at product categories, bridal jewelry sales are still strong, showing growth. Fashion jewelry also saw a small increase. Watches are doing really well, with good growth this quarter. This seems to be a positive area for them. When we look at how they sell, store sales are up, but their e-commerce sales are down. This is directly linked to the struggles of brands like James Allen, which is primarily an online-focused brand. They also have a lot of deferred revenue, meaning money received for services or products not yet delivered. This was over $1.2 billion, mostly related to extended service plans. It is like a rain check for future revenue. The company is still going through a big transformation called the Grow Brand Love Strategy. This has led to significant restructuring costs. In this quarter alone, they recorded about $7.5 million in restructuring and related charges, mostly for employee severance and store closures. Last year, it was much higher, nearly $19 million. On top of that, they had almost $1.5 million in asset impairment charges this quarter. This means they had to reduce the value of some of their assets on their books, likely due to not performing as expected. When you look at segment operating income, North America is still the star, bringing in over $101 million. However, the international segment is losing money, with a loss of nearly $7 million. The other segment, which is their diamond sourcing operation, also lost a bit of money. Now, let's talk about cash. Free cash flow, which is cash from operations minus money spent on big investments like new stores or equipment, was negative. They used about $169 million in cash this quarter. This is common for retailers, especially in quarters where they are building up inventory for future sales. In fact, looking at the cash flow statement, their operating activities actually used more cash overall, about $145 million. This is mainly because they had to pay down a lot of accounts payable, which are bills they owe suppliers. However, they ended the quarter with a pretty healthy amount of cash and cash equivalents, over $600 million. This is a good increase from last year. They also have a large credit line available if they need it. Signet is also actively buying back its own stock. In just this quarter, they spent over $82 million repurchasing shares. This can help boost earnings per S-share, as there are fewer shares outstanding, and they continue to pay dividends to shareholders about $14 million this quarter. It looks like they are committed to returning value to their investors. When you take out all those one-time restructuring and impairment charges, their adjusted earnings per share look much better, coming in at $1.56. This is a significant increase from last year's adjusted earnings of $1.18. This shows that their core business, stripped of these special items, is performing more strongly. The company is clearly pushing hard to focus on its core brands and improve the customer experience. They are reorganizing their marketing and sourcing, and even shutting down some smaller brands like James Allen and Rocksbox to focus on their main ones like Kay, Zales, and Jared. This is a common strategy for retailers looking to simplify and grow. So, what is the big picture here? Signet is going through a major overhaul. Sales are growing a little bit, but profitability is being squeezed by higher costs and the need to write down some inventory due to strategic changes. They are cutting back on expenses and focusing on their strongest brands. The watch category is showing strong potential, and their international business is growing well. However, the struggles of brands like James Allen are a concern, and the restructuring costs are significant. The company is also proactively returning capital to shareholders through dividends and share buybacks. They seem to be trying to become more efficient and focused, and the adjusted earnings per share numbers, which strip out the one. Time charges do show some positive momentum. The risk I am watching is whether these strategic changes will be enough to offset the rising costs and competitive pressures in the jewelry market. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives.